As you can probably tell, I am not Kyle. Kyle sends his apologies today, but Kyle is out on a family trip. So he's been gone for about 2 weeks and he had every intention of attending today, but he's not able to find a place that has solid enough Wi-Fi to make sure that the connection maintains throughout this whole thing. So he asked me to step in, pass along some information. Of course, there's going to be some questions that I'm not going to know the answer to just because, Kyle is super experienced when it comes to the investor side of things. So what I'm going to do is I'm going to go through his slideshow. I'm going to go through the investment side of things, a little bit of it. We'll go over returns. We'll go over what are mix, what is private lending. We'll dig into that stuff a little while. But if you have any questions, please put them on the chat. I'll go through them at the end just because, as I said, this isn't my presentation. So I just want to make sure that I'm concentrating on what we have to do. But I will get to the questions at the end. And if I don't know what the answer is, then I will take it offline and I will find out the answer. And everyone who has a question will get an answer, whether it's from me or whether it's from one of the underwriters over at GMT or whether it's from Kyle when he gets back. My name is Justin. I am the lead trainer at Kyle's group of companies. So that is Origin and GMT. I'm also an advisor at the $1 Billion Blueprint, which is Kyle's training company for mortgage brokers. So I've been about 15 years in the industry. I was about 6 years underwriting for big companies in British Columbia, big funding volume brokerages. So it's something that I've done for a long time. It's something that I'm familiar with. And most of the people who are on here, well, maybe not most, but some of the people who are on here will hopefully know who I am. And if not, then as everyone knows, I'm always up to meet new people and to welcome and to say hello. So let's get going on this one. So today we're going to be going over private mortgages. We're going to be going through what they are, and then we're going to be dipping into a little bit of the investment side on what potentially you guys could do if you're looking to get involved, and not only as a broker or a client, but also as an investor, right? What if you want to actually put money into mortgages, get a return from them? How do you do that? How do you start? What's the first step? And that's where we're going to help you. So for the first thing we're going to do is we're just going to kind of breeze through the differences between A lending, between B lending, and between private lending, just for people who aren't 100% aware of what it is. So when we talk about A lending, so as you can see on the slide, A lending, we're talking about banks, we're talking about credit unions, we're talking about non-banks that are called monoline lending inside the broker world. So with the A guys, we're talking best interest rates, tightest underwriting practices. It's very client focused and moderately property focused. So these are your Scotias, your TDs, right? The guys who want everything to hopefully fit inside their little box. They have GDS or TDS ratios that we have to stick inside, and they have underwriting guidelines that we have to stay below and make sure we come together on in order to make sure it fits with the A guys. If you're going B or you're going subprime, also known as alternate lending, this is where it gets a little bit more flexible, right? So it's a little more flexible than A. It's not as flexible as B. So it's a nice median. So the rates are in there are a little bit higher. So if your A rates are, if they're sitting around 4%, chances are that your B rates are probably going to be, 1.5% to 3% higher, depending on a couple factors that could be inside both the deal and the client. But there's also fees that are included in the B side. So typically you're going to have a 1% to 2% fee. Just because you're going to be getting, a little bit more flexibility, right? Those ratios, the GDS and TDS ratios that are so prevalent on the A side, relax a little bit when you get to the B side. And even more so when you get to that 65% loan to value and under. That's defined as non-conforming properties or non-conforming deals, pardon me. And that's when it even opens up a little bit more. And so at that point, you can kind of start to see a little bit of blending between the private and the B. Not that they actually blend, but just with flexibilities and guidelines kind of starting to open up. And as I said, that kind of takes you into the MIC world, the private lenders, the privates that are going to be lending at the highest interest rates, but are going to have the most flexibility. So rates right now for firsts and seconds, right? First, you're probably somewhere between 6 and 10, and seconds, you're probably between 10 to 15, right? It's much, much higher, but the fees also are increased from the B side. So no longer are you paying 1% fee, you're going to be paying more, maybe a 3% fee, maybe a 4%, 5%, right? We see lots and lots of different type of fee structures that are going to be coming through from brokers, not necessarily inside our company, but also, ones who we talk to outside of of our own book of business, of our own brokers who actually talk about, it's not predatory lending, but there are some people out there who do decide to take advantage of people. That's something we obviously don't strive for, and we really root against, but they are out there and it should be aware. And the biggest difference, I'd say, is that the private lending is going to be equity focused. It's going to be equity focused. It's going to be property focused, right? They're not so worried about that TDS. They're not worried about GDS. They're worried about people being able to make their payments, right? They're worried about them having enough equity in their property that if they do default, right, there's enough equity that's going to be able to pull out and save the file. There's a whole bunch more stuff that we're going to be looking towards when we're dealing with private that we don't consider when we're thinking about the A and the B side. So again, what is private lending? We kind of went through that a little bit, but what we wanted to do is just kind of show what some of the lending options were on the private side. So there's a few different ones. Deposit loans are one, flips are another, and we're going to be going in these a little bit more in detail down the road. So we're just kind of going to breeze past these just to give you guys a little idea on what is available and what kind of financing, private financing entails. So deposit loans, flips, development, right? We're talking construction mortgages, commercial mortgages, right? Building from the ground up. First and second mortgages are obviously the bread and butter of the broker community, and they're obviously the bread and butter of the private mortgages. That's where you're probably going to see most of them, right? You're going to be doing a first mortgage, or you're going to be doing a second mortgage behind, Scotia or TD, if they're not trying to disturb that first mortgage, but still want to pull out some money to do a numerate of different things. And lastly, short-term loans. Short-term loans are obviously a little bit of a higher risk. And again, we're going to get into it a little bit. We're going to show a little bit of examples, show what kind of an interest rate we've seen charged on short-term loans, and what kind of a return we're going to be able to get. So as I said in the previous slide, first and second mortgages are kind of going to be the ones that you're going to see the most of as far as private lending goes. So rates somewhere between 6 and 10%, fees between 2 and 3. Loan to values, typically they're going to want to stay under 75% loan to value, but they have been known to go up to 80. It does happen, so we wanted to make sure that we included that. Interest-only payments are definitely an option. They're not at every private lender. Some private lenders do offer like a 30-year or a 35 or even a 40-year amortization. And what that does is that's going to really allow the client and yourself and the broker, whoever's putting them with it, to pick and choose what lender they're going to want to go with, right? We're going to know that if a client is very cash sensitive and they're going to want to put the minimum in because this is only a short-term Band-Aid and they plan on getting out of the private really, really quickly, then we're going to want to make sure that it's an interest-only payment, right? So we're going to kind of hunt down the lender that offers that. So again, kind of building into the investment side of things is when you provide Green Mortgage Team with kind of your list on how you want to invest, right? Low risk, low real yield, mid risk, mid yield, kind of what you want your money to do. Make sure that you put that kind of stuff in there. The more information that we can collect, the better. And then you're typically going to see a 1-year term, right? Private lending is a Band-Aid fix. We do not want these mortgages on the plate for, 5 years, 3 years. We want to get in, we want to fix whatever solution that was preventing us from going to the A or the B side. And then we want to move on, right? It's expensive. The client knows it's expensive, but thank goodness it does exist because there's sometimes that these guys come into play and it really, really saves the deal. So second mortgages. Second mortgages are a little bit more risky just because of its place, right? You're now behind the first mortgage on title, but with more risk usually comes more reward. So the rates are higher, right? Your rate's going to be between 9 and 15%. Fees are going to be between 2 and 5. Keep in mind that second mortgages are typically smaller than the first mortgage. And same thing, loan to values, 75% loan to value all the way up to 85. There are a couple lenders out there that do second mortgages past that 80% loan to value. Of course, when you're getting up in that world, it's going to be even higher interest rates, even more fees, right? If they're kind of stretching their flexibility, then they're going to want some kind of reimbursement for that. And it's the same thing. Interest-only payments could be a 40-year AM, depending on the lender you choose, open or closed, and a 1-year term. Open or closed, I just want to key on for a second, just because it's an important piece. And again, knowing what your client is going to want to do is the best way to know if they're open or closed. If they know they're going to be getting out in 3 months because they're going to sell the property or something else is going to turn over and they're going to have, a windfall of cash, then we want to make sure that they're not going to be hit with a huge penalty. And we're going to want to make sure that they're not stuck in that 1-year term forever, in which case we look for a lender who can offer an open term, which will be hopefully no payments to discharge the mortgage, which will allow the client to keep even more money in their pocket. So why use a private lender? And in all honesty, the biggest decision to make a private lender your go-to is because the client was declined by the A and the B side, right? Most likely they have tried on the A, they've tried on the B, they've tried to fit all the guidelines and preferences on those sides, and for whatever reason, it didn't. Now, that's not all the time, right? There are certain circumstances that comes up where private lending is required for, maybe we can't provide as much documentation. Maybe it's a super quick turnaround time, right? So there's lots of information that needs to be gathered up, not just you have terrible credit, so you're going to go to a B side, right? To the private side, I've put lots of people that have excellent credit and excellent income on the private side because it was a solution that fit for what they were looking to do. So don't shut the doors to privates. And I recommend never doing that because, our job is to put what kind of information in front of the clients that we can, and making sure that they have all the information and all the options, right? You never know what's going to end up being a good fit. So some benefits of a private mortgage, right? Quick turnaround times. As I said before, lots of the times we get calls of people whose deals fell apart, or the bank pulled the financing last minute, or, I need to do this because it needs to close by next week or I'm going to lose the offer. There's a ton of things that require quick turnaround time. And these are the type of guys that can do it, right? Amazing real estate deals is another one. We want to make sure that we have, and again, this can kind of link right in with quick turnaround times. We got to make sure that the clients can access the funds as quickly as they need to, right? And in order to get sometimes amazing real estate deals, they're going to have access to funds that, maybe can't take 2 weeks, 3 weeks, 4 weeks in order to close. You want to make sure that they have everything they need in front of them in order to get that deal done. Paying off higher interest or credit card payments, right? Credit card payments were 15 to 19%, when really a private mortgage lender, like I said, if you get a first mortgage and someone has no mortgage on their house and they're looking to access some funds, maybe just for a refinance or whatnot, 6% to 8% is a lot better than 15%, to 18% to try and get it. So being able to access funds in order to pay off higher interest funds, again, it's another benefit that we should explore and not shut the door on when the clients come up. Fixing credit is the same thing. Sometimes people get into bad situations and their credit has gone, spiraling down. So the A side can't help, the B side can't help, but maybe they still have excellent credit, right? Maybe they have good loan to value on the property. So we put them in a private mortgage, gives them time to fix all their credits. Maybe they access a little bit of money to pay off their debts, which allows them to try and work their credit score back up. But fixing credit is an excellent opportunity for placing a mortgage with private lending. And it's actually something that's allowed us to fix a client, get paid on one file, and then take them once it's fixed, put them onto the A side, put them onto the B side, get them under a better term, a better product, right? Lower payments. Now that client is, our friend, we've helped them, and hopefully we gain referrals and whatnot from that moving forward. Cheaper than a joint venture cheaper than getting a joint venture partner. And of course, in a bind. So again, in a bind can relate to the quick turnaround time. It can relate to maybe losing a job, right? If a client has an approval with Scotia does an income check last minute, realizes they've lost their job or bought a $2,000 payment truck and no longer qualify, and we need to get the deal done, right? That's a bind if I've ever heard one, and private financing is a great way. Loan to value and everything else, confirming, but in a bind, the private mortgages can really get you out of it. But the biggest one is just flexibility, all around flexibility. So flexibility on the income, flexibility on the credit, flexibility on amounts of properties, right? Especially if you're getting into the investor side of things, where in the broker world, you can typically only do maybe 4, maybe 5 rental properties, right? Being able to access lenders that don't follow any of those rules, don't follow any of those guidelines. They're just looking at equity, right? They want to make sure that the deal makes sense. They want to make sure there's enough equity in place. And if those two things fall in line, then the flexibility abounds. Right, flexibility is a huge portion, right, from the A to the B and the B to the private. The flexibility is a big key. So some additional beneficial offers for private lending. So zero down, and for zero down, we're talking inter alia. Inter alia, for anyone who doesn't know what it is, it's when you blanket. So if you own this property and you're buying this property, a private lender has the ability to kind of blanket a mortgage over top of 2 properties, and in essence, reduce that loan to value that's required on that new property you're trying to purchase, because they're taking some of that loan to value off of the other one as well. So again, flexibility, interesting options, right? Not inside the box. It's great ways to think about it. And it always comes down to, zero down and then running your numbers, making sure it's a good thing for the client. So no payments. For no payments, what we're talking about is an interest reserve fund. And interest reserve funds are super interesting things. So lots of the times with private financing, when we're talking about people who maybe have lost their job, right? People who maybe are going through a really bad divorce, and maybe they took some time off in order to collect themselves, but have every intention of going back. Right? With private financing, the story matters. So with an interest reserve fund, as long as the loan to value and everything lines up, what we're able to do is tell the lender that they can not only fund that $200,000 mortgage or whatever the actual amount might be, but they can also take off another $220,000, right, or another $20,000, in essence, making it a $220,000 mortgage, and making sure that that $20,000 goes into the interest reserve fund, and therefore the client has no payments throughout the 6 months, 12 months term of the mortgage. And what that does, that's going to give self-confidence to the client, right? Knowing that they have the opportunity to not make a mortgage payment for 12 months, dig themselves out of whatever headache or whatever hardship got them there in the first place. But then the lender obviously has issues about being able to make their payments, right? And in that case, them having that extra $20,000 in an interest reserve fund, again, I say $20,000 just as a number I grabbed out of thin air, but it gives them the knowledge that those payments are going to be made, right? Those payments have already been paid. They've already been made. So they don't have to worry about affordability issues. The client doesn't have to worry about affordability issues. And again, it allows you to put an excellent opportunity in front of the client and a really, really neat program in order to make sure that the client can access anything that they need to hopefully get them on a better foot. So rent to owns, RTOs. Private lenders are definitely the ones to go for this. I am not an RTO expert by any stretch. I've been in this industry for 15 years and I've done 2. So I can't speak on RTOs too well, but I know on the A side, there's a whole lot of jumping through hoops that we have to do. Same thing on the B side. We have to make sure that it got set up correctly when the RTO was originally signed, right? The down payment, right? Because what an RTO is, in essence, if there's $1,000 that's going to the landlord, then there's an agreement that out of that $1,000, $800 of it is the actual payment, and $200 is supposed to be going to and linked in a separate bank account and used to save up for a down payment on that property, and which they access when the property goes up for sale or when the contract point reaches that stage. But if it wasn't all set up very, very accurately at the start, that can all go very sideways very quickly. Construction draw schedules. So construction draw mortgages are a tough thing to do, especially on the A side. There's been lots of lenders that have taken the construction side away from the brokers. And it's really kind of a niche program where you have to know exactly what's going on. And the reason being is because there's draw schedules, right? If for anyone who ever built a house and not a completion mortgage, a draw mortgage, they know how time sensitive and inspection report verifying. It's pretty intense process of knowing, you have to send an inspector out at lockup stage. The inspector then has to report back to the lawyer. The lawyer then has to confirm with the lender. The lender then releases the next set of funds to the lawyer, and the lawyer gives them to the builder, right? So it's a lot of steps. It's a lot of back and forth. Whereas with the private side, it can be a lot easier, right? It's where that flexibility comes into play. So if that is something that you're looking at getting into on the private side, at least, I suggest reaching out to some private lenders, finding out who's got an appetite for, construction draw mortgages, finding out what their schedules are, because there's definitely an opportunity to, not only get some money in your pockets, but help people out and probably build a pretty healthy book of business around just construction draw schedules. And finally, operating and holding companies. So this has become increasingly popular over the last little bit. Obviously, we had a big influx in people of purchasing, rental properties and other properties during the lockdown. And lots of people have kind of been digging into the holding operating companies saga and wondering, why is it a benefit? Why is it not a benefit? When should I do it? What should I do and how to do it? And there's lots of A lenders who don't lend in holding company names. So the actual tax benefits that you could get from, we'll say, buying a rental property in a holding company name wouldn't be able to be accessed by, a good number of the A lenders, some of the B lenders as well, but they're a little bit more flexible. But the private lenders are game for anything, right? So as long as it makes sense and you can sell the file to them and let them know, who the holding company is, who owns it, make sure it's on the up and up, it's definitely a good way if the client finds that that is 100% what they need to do, is get it in a holding company to make their, because they're probably going to have plans, they're going to have schedules, they're going to have, dreams of their own on what they want to do. And if a holding company name is what's going to get them there, then being able to, again, put options in front of them is going to be the one that we're going to want to do. So next, we're going to jump into why be a private lender. And I think it's a pretty straightforward answer, which is hopefully to make, a good chunk of money, because every investment is that, right? We want to make sure that whoever gets in there is going to make some money. The people who are coming to us or coming to the person who's lending, again, gets their solution done. But if the money has to be lent and you have it, then again, we want to just make sure that everyone is aware that you can do this. You can lend your own money. And there's a couple different ways, and we wanted to touch on two of those ways tonight. So some of the benefits of being a private lender, of course, you're going to have, your equity to your debt ratios is going to be fantastic, right? You're going to hopefully get in there. You're going to have a lot more of one than the other. I think we all know which one the good one is. So I won't stick on that too long, but reasonable returns, right? Reasonable returns is a fantastic thing to think about. It's why we're in this game in the first place. And what we have to do is consider, what money you're accessing, what the interest rate you're accessing that as, and what money you're going to be lending out, and what the interest rate you're lending out at is as well. So buying is a lot harder than the lending side, right? If you're buying properties, you're going to have to manage those properties. You're going to have to deal with tenants. You're going to have to deal with, maybe a property management company. There's fees that come out of there. You're going to have to spend some time going out and actually looking at the properties, spending your own time and effort to get there and find one. Whereas if you're just investing on the mortgage side, you're coming to us or you're coming to a MIC and you're just saying, hey, here's a bunch of money. Here's my lending criteria. What can you do for me? And then we're going to come back and we're going to tell you exactly what we can do for you. And again, we're going to get into that a little bit more, not too much in depth. Like I said, if there's some questions or whatnot surrounding the investment side, and by investment side, I mean your investment side of investing your own money into mortgage lending, then there's an email address that we're going to put up at the end, which is info@greenmortgageteam.ca. And what we've prepared is we prepared a package, so a nice PDF package that we can send out that gives all the information, and it actually gives access and connection between you and the GMT team. Right inside the GMT team, we have account managers and we have underwriters that specialize in the commercial side of things. They specialize in the private lending side of things. So they're going to be really, really in-depth answers when you're talking to them. So right now, like I said, I'm not Kyle. So I just wanted to kind of breeze through this, give you guys a good idea of what private lending is, give you guys a pretty good idea of, some investment opportunities that are out there right now. I also put together a couple things on some investments that we've done in the past, just so you can see kind of what we charged, what the scenario was, what the fee was. Again, just getting a general idea of maybe some ideas towards how you want to invest your funds if you do decide to go forward with this. So it's more liquid than owning real estate, right? Private mortgages, as I said before, these are not long-term solutions, right? We want them in and we want them out, and that's it. We want the 1-year term or less, right? We get in, they pay their fee, we have the rates, they get out. Then we reinvest that money, you pocket whatever you want to, reinvest it again, do it all over again, right? As opposed to having to list a house, sell a house, right? Go through that whole rigmarole. We're hoping that this allows you to have easier access to, a really, really great investment and a really great investment opportunity. And as far as I'm concerned, the best thing is the better cash flow. And I can speak from personal experience on this one. Better cash flow, in my opinion, is the key to this whole thing. I like to know that I'm making money every month. I like to know what's coming in, what's going out. And this is a fantastic opportunity to do it because I know what the fee was charged. I know what the interest rate is. I know how much money we're going to be getting at the end of this. And I know how much we can allocate as far as monthly cash flow goes towards what's coming in and what's coming out. So again, this is an excellent piece. And I'm glad that Kyle put that on there. So properly assessing risk, right? Private lending underwriting is much, much different than the A or the B side. So what we want to do is we tend to look more, I'm talking about the GMT team, they tend to look more for the low risk, low yield, or mid-risk, mid-yield returns. So that's when we're acting as for both the borrower and the lender. So if there is a high risk, high yield opportunity, typically we bring in the MIC, right? We bring in a private lender. That way we can kind of put it over there, put the client with them, and then we continue to just act on the borrower's behalf, right? So we kind of shift everything if it goes to a too much of a risk. And again, this is just a comfort level. So when you're sending in information on things you'd like to do, right? Maybe you want to invest some money. So you send GMT an email, Green Mortgage Team an email to that address. And let them know what you're looking to do. Let them know what your risk factors are, right? Let them know what you're looking to lend on, how you're looking to lend. Explain everything, because with GMT, with Origin, with all the companies that Kyle owns, right, he gets a constant supply of people coming to him looking for mortgage placements. So if we can find enough money to fund that and all those people that are coming and asking for it, then there's going to be lots and lots of opportunities to fit with all of those criterias, as long as they're listed upfront and we know exactly what we should be looking for. So to properly assess risk, we're going to look at 3 main areas. Area number 1 is going to be property, location, type, and loan to value. For private mortgages, again, not like A and Bs. A and Bs are going to be more, right? A is very client heavy. B is kind of a mid-level between the property, equity, and the person. And private lender is going to be mostly equity, mostly property, mostly location, right? So that's going to be the first thing that we take on to actually have a peek around, make sure we know what it is, and make sure that the exit strategy is clean, right? Exit strategy, for those who don't know, and again, in my opinion, is the most important thing in private financing. So when you're providing a application to, we'll just say a MIC, we'll say Antrim. Antrim Financial is a mortgage company, a private lender that's in Vancouver. So we'll say we gave a mortgage deal to Antrim. What they're going to want to know is, how are these guys going to get out of this? Right? This is a short-term solution. And as I said, they don't want it on the books for a long time, just like you as an investor wouldn't want it on the books for a long time. So the exit strategy, are they going to sell their property and repay us? Are they going to get back into their industry that they've taken a short stead from and then be able to pay us back with that front? And then we can refinance them onto the A side or the B side. Then the private gets their money back. The client goes into a better rate term product and everybody is happy. But the exit strategy is super important. And we want to make sure that we key on that every time we get an opportunity that comes through. And then finally, the borrower. Like I said, this is a completely flipped 180 from the A side. On the A side, the borrower would be the biggest, most most relevant thing that we're going to want to consider. But here, the borrower, we're looking at income, sure, right? We're going to look at it. We're going to see what's going on. But again, the loan to value is going to be the main thing that we're going to consider. We're going to look at how many properties they have. We're going to look at if they do this as, a profession. Are they a professional flipper? Do they own 37 other revenue properties, all held by private lenders? Right. So we're going to go in there. We're going to assess. We're going to use these three things. We're going to use this pyramid to assess that deal to make sure that we're mitigating any risks that we could have from potentially placing this not only with a MIC, but an investor such as yourself if someone does decide to go forward with that. So examples of private lending. I did know that I told you that we were going to talk about examples that we have gone through in the past. So we're going to start with, again, what most people are going to see the most is first mortgages. So for this example, first mortgage, bridge financing, self-employed borrowers, retirees, many other, right? There's lots of opportunities as far as first mortgage goes. For those who don't know what bridge financing is, bridge financing, also known as interim financing, is required when you don't have your down payment and your down payment is coming from the sale of a property, but that sale is going to be closing after you take possession of this new place. So you actually need to bridge the down payment between the sale and the purchase. And it's a big opportunity. And the reason being is that there are some A lenders and some B lenders, I believe, that don't offer bridge financing. So in that case, the broker or the client needs to go outside of that lender and find bridge financing because they need to close their file. And in which case, private financing is usually the way that they end up going. And it's actually quite expensive. So as you can see, right, a $600,000 loan, 65% loan to value, 7% rate or 7% rate with a 1.5% lender fee, right? What does that work out to? $9,000. And yes, it's 7 o'clock and I needed my calculator for that. So on to next, we're going to be doing the second mortgages. As we said, second mortgages are typically a little bit more risky than the first one, just because they're in second position on the title. So for second mortgages, we're looking at things like debt consolidation. We're looking at things like paying off the CRA debts. Again, it's a huge opportunity because on the A side, you need to have your debts paid off in order to get funding from the A lenders. So in order to do that, right, sometimes you have to get creative and find creative ways to access these guys' money. So paying off CRA debts, business loans, again, so many others. But what you're going to see is you're going to see a smaller loan amount because typically the seconds are going to be smaller than the first. Loan to value, 58%, 10% rate, right? The rate is going to be higher because it's a riskier program and a 2% lender fee. So again, the lender fee is a little bit higher, obviously $150,000 loan and a 2% fee, right? That's going to be a $3,000 fee that they're going to put in their pocket. But again, it's about finding solutions, right? Hard term loans. So this is hard money, super risky, right? Maybe business loans, as I said, renovations, flips. A lenders don't like flips. They like to get you in. They want you in for 5 years. They want you in for 3 years. They want to make money off that interest, right? Where private lenders are okay lending for short term. So for this one, for example, right, a $20,000 loan, maybe it was, maybe they needed it for to pay their salary for their employees. So they needed it for a flip. Maybe they needed to finish their renovations. So you're going to see a smaller lender fee at a 2%, right? That's only $400, nothing to shake a stick at, but a 25% interest rate. So again, right, you're mitigating your risk and reward with your rates and your fees. And we're going to keep going because there's a couple more that we wanted to touch on. So deposit loans are another way that you can do it. So buyer's equity home in the sale, it's usually only 6 to 12 weeks, and it's about $1,000 per $15,000 lent. So on a $60,000 loan, it's only out for 2.5 weeks, and there's a $5,000 lender fee. Deposit loans, for those who don't know what they are, sometimes when you have a house and you sell it, you don't have any more money to put a down payment or a deposit on the new property, right? Lots of times when you go to buy, actually every time when you go to buy, the realtor always asks for a 1% or a $10,000 or a $50,000 deposit, and not everybody has it. So deposit loans are a great way to make some quick money, right? It's a 2.5 week turnaround time. And usually you get kind of all the information about what the other side of the deal is doing as well. So the sale. So you can probably bet that it's going to be a good file, right? Because if they didn't come to you for the actual mortgage being placed, they only needed you for the deposit loan, that mortgage is probably being placed with an A lender or a B lender, which means their qualifications are going to be excellent. And it's probably going to be a pretty good investment. Flips. We just touched on this a little bit. I actually just finished one of these with a private lender in Calgary the other day. Hard to get financed for flips. As I said, on the A side, they don't like it, right? They like to have people in. They like to have them for a longer term. They like to get them to buy their credit cards and their lines of credit and everything else. Operating company name, it can be hard with residential lending, and the rate's not as important, right? Especially on a flip. These guys are wanting to get in, wanting to get out nice and quick. The rate doesn't really affect because they're not planning on being in it for a long time. So we mitigate with maybe a little bit of a higher interest rate, or pardon me, with a little bit of a higher lender rate, right? So a $310,000 loan, 65% loan to value, right? Falls within that 795 range. And then that's a 2% lender fee. So $6,200. So again, a nice healthy fee, and depending on how long it takes to get back or depending on the terms that you've arranged, can be an excellent investment. And finally, development, right? Bank finances are tighter, private lenders can be more flexible, and it's great for lenders who are ex-builders and developers. So if you have a history as a contractor, as a builder, as a developer, as anything on that side, you are already well aware of draw schedules, inspections, progress reports, everything that comes with development, whether it's commercial, whether it's residential, whether it's anything. So, if you're getting into an investment side of the business, why not go with something that you're already aware of, that you already know lots of the terminology surrounding, because it's just a comfort level at that point. And as you can see, right, $1 million loan, developments are expensive. A 50% loan to value, fantastic loan to value, 9% rate. So again, right in that middle, but a 1% fee, right? Because it's $1 million loan, that's a $10,000 fee. So again, just depending on how it all does and how it all plays out, a $10,000 fee is an excellent start. And then, residually receiving your interest, whether it's monthly or paid out on the end or however you set it up. Again, it's a great opportunity. And so what do you do if you don't want to kind of be a part of it, if you don't want to manage it, if you don't want to be involved in making the decision on who's actually going to get your money? Invest in a MIC. So a MIC, MIC, is a mortgage investment corporation, right? And there's a ton of them. There's lots of them out, and they're all short of money right now. And the reason being is that it's just no one's investing, right? No one's investing. Lending criteria on the A and the B side is getting tighter and tighter and tighter. So the need and the drive for private money with those flexible options and those quick turnaround times is just increasing. But the short amount of money that's coming out right now, or that's being invested just because of the uncertainty, is leading to not a lot of money being available in the private side. We've actually had some private MICs that have, either said they're not lending until, 1, 2, 3 months down the road, or they've shut their doors for the next 2 to 3 weeks, or whatever. We receive those emails quite often, and that's usually the reason. And what that's going to allow you to do is just be a big part, a small part of the bigger deal, right? Because then the MIC is going to lend out your money to whatever property investment opportunities that come around, right? That come onto their desk. They're going to allocate that money properly. You're going to know it's being managed, and you can kind of sit back and forget about it, just like any kind of an RSP or a GIC or however you would invest in that. It's the same kind of thing. And again, if you want to invest in a MIC, we can help you out. So send your email, send your information to info@greenmortgageteam.ca, and I will put it up at the end. But not only for us being able to, hopefully direct some self-directed investments and being your own private lender, but if this is a little bit more of the opportunity that you're hunting for, reach out, right? We'll be able to use our knowledge, our experience, and hopefully point you in the right direction. And so what are some ways to get started? So mostly people are going to be using what is probably going to be the equity in your house. So there's a couple ways to do that. And again, it completely depends on what your loan to value is on your existing property, right? If your house is completely paid off, good for you, right? That's wonderful. But it's not making you any money except for what your value is gradually gaining. So if you're like me, at least, you've probably gained a whole bunch of value over the last 2 years, which is fantastic. But we all know that that is not normal. That is not the everyday thing to have your property value increase by, I think mine increased by 46% this year, something like that. So we want to look for other ways to use that money, right? To get that money working for us. And most of the time, the people who are talking about it are talking about home equity lines of credit. So what a home equity line of credit is it's another way that we can access the funds inside your mortgage or inside your house value. So even if you have an existing mortgage or if you don't have an existing mortgage, we can look to either help you place a home equity line of credit in order to get a lower non-deductible mortgage loan. So Scotiabank, for example, has a program that's called the STEP program, which is the STEP, which is the Scotia Total Equity Plan. Pardon me. It's very dry in my office today. And what the Scotia Total Equity Plan does is it allows you to allocate a couple different areas of your mortgage. So if you had a $200,000 mortgage, you could put $200,000 in a fixed or a variable, and you could put $100,000 in a HELOC. Pardon me, $100,000 on each, right? You can split it up. You can mitigate your risks from taking all your money and dumping it into a variable or all your money and dumping it into a fixed. But the best part of that is when you're paying down your fixed rate portion, the principal that you're paying down becomes available on your home equity line of credit, right? So as you're paying that down, now this balance is going to be coming available, which allows you to flip it in, use that money to reinvest into real estate, into the private lending market, however you do. And if you're investing at 10%, 8%, 15%, whatever it is, and you're borrowing at 4.95%, right, then you're obviously going to be creating a spread of somewhere around 4.05% on your equity, which again is just allowing your money to do a little bit of work for you that it wouldn't have otherwise. So other ways to access funds. Obviously, not everybody owns a house. Not everybody has a whole bunch of equity available. Not everybody can do that. So there are a couple other ways, and we just wanted, this isn't all of them, but we just wanted to put a couple out just to let you know what's available, right? So RRSPs can definitely be used, but they must be self-directed through Olympia or Canadian Western Trust. And of course, sorry, guys. And of course, cash is the next one. No restrictions on cash. I don't think anyone will ever have restrictions on cash. You bring the cash in and all the doors open. And of course, TFSA, right? It's as good as cash as well. And yes, you can absolutely use that. And if you want more information on that, like I said, we'll put up the information pack at the end. But we really just wanted you guys to start thinking about your retirement strategy, right? Not everybody, and myself included, right? I'm business for self. I've been business for self for 15 years. I do not have a pension, right? I have not paid into OAS. I have not paid into CPP. So when I'm finally at that stage, I have to have set myself up. So whether that's real estate investing, whether that's RSPs, whether it's, anything in order to make sure that you have continuing monetary contributions even after you're done retiring, depending on how old you are. Whether you're old or young, honestly though, it doesn't even matter. Planning is great, and moving forward with it is important. So as far as the Green Mortgage team, I'm not sure if anyone has been on their website. I'm sure everybody has. Hopefully this is where you got this invitation from. But on there is an investor survival guide and is also that private lending package that I was talking about. And it lists any upcoming webinars. Kyle will be back in Wi-Fi mode and probably within the next week. So he should be back in action for the next one. But I wanted to key on that private lending package again. Like I said, I'm not going to be able to answer all the questions for you guys as far as investment mortgages go. But the team over at GMT will. And in order to access them, I'll put it up in a second. But you can book your consultation online through the website, fill it all in, let it out, or send it through, and one of the account managers or somebody will be out there to reach you, or will reach out to you, pardon me. And finally, the contact us. So we're located in Vancouver. Our office is just off Granville. greenmortgageteam.ca is the website, and that info@greenmortgageteam.ca is the email. Everyone write it down if you have any interest in actually taking your money and turning it into a real estate investment or a mortgage investment. And of course, the phone number 604-229-5515 is how to reach us. So that's pretty much the end, guys. I will take a look in chat because I haven't at all, so I'm not 100% sure on if anyone has asked any questions. And more importantly, I'm not 100% sure on how helpful I will be on the answers, but I will definitely try to answer. Let's see. Yes. So the question is, so GMT underwrites the borrower's risk? Yeah. So as I explained, the Origin Mortgages or Green Mortgage team have a constant supply of clients for the most part, coming and asking for our help. So they're going to be the ones who are looking through the file. They're going to be the ones who look at whatever you put down on your investment wants, needs, desires, and whatnot. And that's how they're going to match it up. So when you do put it through, as far as minimum amounts, I had someone ask that as well. So the minimum amount, I'll be honest, typically it's going to be about $100,000. And the reason being is that that's probably what the most people are going to be asking for. Most people are going to be asking for, a second mortgage for $100,000 or a flip, right? It was pretty rare for those short-term $20,000 loans or $25,000. That's not to say that they don't happen. They absolutely do. But if you're trying to access as many clients as you can, then of course, and I know I say it, it's easier said than done, but the more money that you're able to invest in this, the more opportunities to fit into the certain file type. It's hard to explain, but hopefully I've laid it out enough. More money is better. The less money that you have, the less deals that are going to fit into your criteria. So the less opportunities that are going to come around. Some of the best mix that you recommend. I honestly I can't say for sure. I know I've received a bunch of emails over the past probably 2 or 3 weeks from Mix asking me if I'm interested in investing. And I think that's just because I have a relationship with them, right? I know them. They're reaching out to me. I'm the trainer at Origin Mortgages. So I am responsible for setting up all the agents over there with, lender meetings, lender information, lender knowledge and whatnot. So through my experience with them, they've been reaching out. But like I said, go to info@greenmortgageteam.ca. And I know I keep pushing that and I apologize, but they're really going to be the ones who have the best insights as to, maybe who has the best returns, who's the best easy to work with. If they've heard any horror stories that come back, right, that's going to be the people whose expertise you're really going to want to lean on. So I apologize, John Doe, but I'm not able to answer that any more directly than I already did. How does Green Mortgage Team get paid for private lending? So yeah, we get paid by the borrower in the form of a fee. So the same kind of thing. So you don't pay us, you wouldn't pay Green Mortgage Team, but I'm going to bet dollars to donuts that that's available inside that private mortgage package. And it looked like you could either find that on the Green Mortgage Team website or at that info@greenmortgageteam.ca. So the one says, hi, how about lending RESP? Is it safe to invest in real estate for this nest? I'm not 100% sure what that means, Rajit. If you can clarify, I'm happy to answer or try to answer as best I can. Angie, do you only do mortgages for properties in BC or you do other provinces? Yeah, we do provinces as well. We can go all over Canada for the most part. We obviously are specializing in BC. So most of our contacts are going to be at BC Mix. But we are in the middle of being licensed in Alberta and we're in the middle of being licensed in Ontario as well. So yes, we have access. And if we don't have access to it, we're going to know someone who does. So if you have an opportunity that comes up in Ontario or in Alberta or wherever, same thing, right? We're kind of your one-all where you can just reach out. And if we're not able to directly help you, which is probably going to be pretty rare, we can probably point you in the right direction. Can you explain a draw schedule loan? Vanessa, unfortunately, I can. So a draw schedule loan is a construction draw loan. So when you do a mortgage, when you do a builder's mortgage, there's usually about 2 ways that these are going to happen. One is a completion mortgage, which is they sign it, they give that 5% down payment, it gets built, the mortgage closes at the end. Everybody's happy, nice and simple. A construction draw mortgage or a draw schedule loan is when maybe it's a smaller type builder that doesn't have enough money to fund a whole build on themselves. There's also other reasons that they do that, but it gets broken down into different draw schedules. So you might need, a draw at the beginning to buy the land and get started. And then the next draw might be at drywall stage, right? Again, each lender is going to have a different schedule, but the next one might be a drywall stage. So at that stage, an inspector has to come out, make sure that the house is being built, make sure it's at drywall stage and everything is as it should be. He will then send that progress report to the lawyer. The lawyer will review it, let the lender know that, yep, it's there, we need the money. The lender then gets the money released to that lawyer. The lawyer then releases it to the builder, and the builder can move forward. And then when they hit the next one, right, maybe the next draw schedule is going to be at lockup, then the same process repeats itself. At these processes, the client is responsible for paying for the progress report inspection. So it's another unnecessary cost, I guess, when you're doing a draw mortgage, at least compared to a completion loan. And then it eventually ends with, whether it's 4 draws or 5 draws or however that's set up, eventually it ends with, everything is done, completion happens, and away you go. But there's lots and lots of moving parts. And that's why it's kind of a niche product. It used to be much more common when, Scotia or TD allowed brokers to actually do that. But they've taken all that stuff in branch, which limits the broker's ability to do it inside the broker channel, which means we're going to have to go outside. So that's to, whether it's to private lending or maybe onto like CIBC, but small business lending, small business loans. So again, it's a whole other type of the mortgage industry. But yeah, hopefully that answered your question. Angie, what percentage of your mortgages do Green Mortgage do with major banks versus private lenders? I can't answer that 100%. I'm not on the GMT side, right? I am as far as the trainer goes, but GMT is extremely experienced, so they don't really need a trainer. I'm more of a trainer on the Origin Mortgage side, which is actually Kyle's like origination brokerage. But I would say, just from like an educated decision, I would say, they probably on the GMT side, because they're mostly dealing with investors and whatnot, I'd say private lending is maybe 30 or 40%. But again, please take that with a grain of salt. If you go to that info@greenmortgageteam.ca and they tell you 20, don't come back to me saying that I told you the wrong answer. But I would say it's that, just because of the type of business that they specialize in. Is the investment principal guaranteed? Any restrictions to withdraw the money? I'm not 100% sure, but it's an excellent question. So again, I'm going to put this back up just in case anyone actually wants to do it or it wants to take advantage of it. But that info@Green Mortgage Team is definitely going to be your resource to get that question answered. Same thing with for Rajit. He or she asked if our ESPs, I assume you're asking if they can pull that out in order to invest, and registered educated savings plan. I don't know. Like I would love to answer, and my heart says yes, but like it's such a different beast than anything else in the mortgage world when you're talking about private lending and private investing. And I would hate to give you non-accurate advice. So I'm going to point you to the info@Green Mortgage Team again, just to make sure that you get taken care of correctly. Do you foresee private lending rates increasing shortly due to the prime rate increase over the past 6 months? As I have seen most of private lending investing rates the same as a year or so ago, do private lending rates lag? They've definitely increased, right? Before we were talking about, first mortgage, you were 6%, right? 6 to 7, that kind of thing. And now first mortgages, like we said, are somewhere between 7 and 10, right? So it's definitely seeing an increase. On the Origin side, or the Origin Mortgage side that I see, I don't see as many private lenders as the GMT side does, but there's definitely an increase in interest rates. As far as do private lending rates lag, I don't think they lag too much. It's all kind of relevant, right? It all happens at the same time for some reason. And because they're getting their money from other sources, right? They're not mortgage-backed securities. They're not getting it from, a big bank, right? There's lots of the times when you're dealing with a monoline lender or a B lender, right? They might be called ABC lender, but they get their money from, RBC, or they get their money from Scotia or Merrill Lynch or something along that line. So I'm going to imagine that they probably keep up with desired or expected return rates and probably adjust their interest rates according to that. But I have no data to support that. So again, greenmortgageteam.ca is probably going to be your best source of information if that didn't support and if you wanted to dig into it a little farther. What is the minimum to invest with the company? I don't think there is a minimum, right? Like I said, the only thing that's going to differ is the amount of opportunities that are going to come up, right? If you're going to come up and say, you know what, I got 10 grand, right, which is fantastic. You know, everyone's got to start somewhere. You got to invest, but odds are that the amount of people that are going to be coming asking for a $10,000 private is probably going to be pretty minimal. So when you get to like a 50,000, that's probably going to be about a limit that you're going to want to do as far as investing your own money and being your actual own private lender, just because of the amount of opportunities that are going to come up. Of course, 100,000, 200, 300, you know, the offers will be, you know, way more. But if you have like 5, 10, 20, maybe a MIC is something that you're going to want to invest in, right? I know, Alta West, ALTA space WEST is a MIC, and I received an information package from them maybe 2 weeks ago, and I believe that their minimum investment is 5 grand. And they have a couple different options that you can invest in, right? I think it's like a mid-level and a high level. So again, reaching out to that Green Mortgage team address, they're probably going to be able to give you some great advice on MICs that maybe they're going to take that 5 grand, right? Build up that 5 grand, turn that into 50, and then go into your own investment, because that's where you're going to make, you know, even more money and more growth. So that type of thing happens all the time. What percentage of borrowers default? What percentage of lenders don't get back all their money that was lent? I don't know. I apologize, Kingsley. I'm not 100% sure on what those stats are, but in all honesty, I'm interested as well. It's an excellent question, and Green Mortgage team is probably going to be the best result. For deposit loans, is this secured or unsecured as a lender? I would have to assume that it's going to be secured, right? It's going to be secured against the property that they're selling, because that's, once that property sells, then we're going to want to get paid out, right? So more than likely, you're going to get registered on title for, you know, 100,000 or 150 or whatever the actual deposit loan was. And then once that property sells, you'll probably take your cut out of the equity. Again, though, I'm going to reiterate the same point where you're going to want to check with the actual high level experts just to make sure that what I said is accurate. Now that the mortgage rates are so much higher, do you expect that with buyers who have to complete on their pre-sale purchases and can't borrow enough money from an A lender to complete the purchase, do you think a lot of buyers will go to the private lenders to borrow the shortfall? Yes. Honestly, probably yes. I don't think we've even started to see the fallout from pre-sale nonsense, right? I've heard of a couple things. We have a bunch of chat rooms and whatnot that our brokers use. I'm going to grab another drink, pardon me. And we've heard crazy stories, right? They bought for 1.1 million, you know, and now they're closing. And for whatever reason, getting the appraisal was delayed because it's not done yet, right? And the appraisal, the lenders are going to go off of, you know, the appraised value or the purchase price, right? Whichever is less. So if the purchase price was 1.1, but now the appraised value is 9, they're going to lend on 9. So anyone who's wondering what those questions are, right? Now the client finds himself in a crazy situation that they have to find an extra $200,000 or completely adjust their loan to value. So yes, I think it is going to be, again, it's just going to depend on the loan to value that's going to come through, because there's not going to, you know, if you're an A lender and they're lending a 90% loan to value, no A lender is going to let a private lender go in second position for an extra 10% up to 100% financing. So it's going to be completely deal dependent, but it is going to be able to save a file or two. If their loan to value is, you know, outside that 80% mark, and you can really work the numbers to make sure that it fits and everybody's on board, then I think, and I've talked with a couple lenders who are sympathetic to the situation and sympathetic to the clients. So I think, and you made an excellent point, that it's probably going to end up being, I know a couple people have, you know, reached out about adding home equity lines of credit or refinancing other properties, gifts from mom and dad, right? All those type of things are getting thrown as well, just because private lending is expensive. And if you are holding the A mortgage or holding an A or a B mortgage and you're placing a private, you're probably going to have to disclose that to the B lender or the A lender, in which case they're going to want to debt service everything to include that now existing private mortgage loan. So how are borrowers qualified? experienced flippers versus newbie. How much information about the borrower is provided to the lender to assess the risk of the borrower? How much information is provided to the borrower about the borrower? I apologize. Is provided about the borrower to the lender? Yeah, lots. So what we're doing is when we put together a file, it's the same kind of thing, right? We're still going to find out exactly what the person does, what properties they own, if they own rentals, how much is the rental income, what are the offsets, right? What are the interest rates, payments, credit? It's a normal file, right? We just on top of that, we're looking at things like affordability. We're looking at things like the exit strategy, like I said before, right? One of the most important things in the whole game. So yeah, it's a fully disclosed file. It's not like they're calling up and saying, hey, I need a mortgage. And that's it, right? And we're just giving out the money. But no, there's definitely a big vetting process because we want to make sure that, one, if we're placing the file with a MIC, right? Or if we're placing the file with an individual, we want to make sure that that file is going to be clean. We want to make sure that the person who is lending out their money, be it a MIC or be it a private investor, is fully aware of everything that's going on, is fully aware of any risk that might go into it, right? You might say this person doesn't have any income, but it's only 30% loan to value, right? So again, you might be able to mitigate that risk by popping up the fees a little bit. But I expanded on that a little bit, but yeah, it'll be a fully vetted process, and I believe there is a sheet that is provided with the information pack that should actually kind of show what all the questions were and what information is gained. Again, I'm not 100% sure on that, but it would make sense to me. Hi, Angie. I'm not 100% sure if the slides are going to be shared. I don't know what Kyle does typically at the end of the webinars. I'll make a note though and see if he is able to share it. But if it is, reach out to info@Green Mortgage Team because that's probably going to be the best way for you to get that actual, the PDF slideshow if that's something that interests you. The fee paid to GMT is paid by the borrower or the lender? Borrower. Is the lending fee a one-time charge? Yes. So when you're placing the mortgage, you're going to get, the 1%, 3%, 5% fee. They're going to pay it, goes in the pocket. The mortgage continues, interest rates, interest-only payments, amortized payments, whatever it is. And then hopefully they pay out that mortgage. That money becomes cleared up again. It goes back to the start. We collect another fee, right? And it gets lent out again. Right. So that's kind of the process. That's the repeat process. So you collect money on the fee, collect money on the rate, nice short term, rolls over. And this is why the exit strategy, again, is so important, just because that's going to show you when that money's gone and when you're going to be able to reinvest your investment. What does GMT do if there is a default from the borrower? Vanessa, an excellent question, and I'm not even going to take a shot at that. I don't know, and that's an important question. So reach out to the info email address and get the for sure answer, because again, it's going to be a long process, and there's probably lots of up and downs involved in that. But it's a good thing to know, right? Whether or not you're getting involved for the private investing side of things, right? You want to know that worst case scenario. You lend out your money, it goes into default, what happens, right? And they're going to be the ones, and it's probably included in that package because again, to me, that would make sense to include that information in there. But if it's not, just make sure that you put that information in the email and ask all the questions, and somebody else on the other end is definitely going to take care of you. How about construction costs, escalation, and delays driving need for extra financing on development projects? Yeah, David, it's super common, that's for sure. So when things like that happen, again, from my understanding, it can be reassessed, and it's completely dependent on the situation, the loan to value, right? All that stuff that drives the file. But lots of the times, and it happens, not only in big type situations like you were describing, but also on like little ones, right? Where someone, maybe they borrowed a first mortgage and then 2 months later, they realize they didn't borrow enough. So they need to borrow another second. And then I've had it even where that they're looking to borrow more, but the lender doesn't offer third mortgages. So we roll the first and the second together into one and do another second, right? So there's lots of flexibility inside the private lending. I'm not sure if that actually addressed your question or just kind of danced around it. If it didn't answer it, please info@greenmortgageteam.ca, just because I want you all to be taken care of and I want you all to get the answers that you're looking for. Thank you, Vanessa. I appreciate that. My screen shows chat disabled. I can see it, Shelly. So it's not disabled. Is GMT a form of a MIC in itself? Example, does GMT serve as a matchmaker? By the way, you're doing an awesome job. Thanks, John. I appreciate that. John actually didn't say that. I just put that in to build up my own confidence. He did say that. No, GMT is not a MIC. Just because a MIC takes investments from everybody and pools them together and then lends it out, right? Whereas Green Mortgage Team takes Bill's $100,000 and lends that $100,000 to someone who needs it. Then they take Sally's $50,000 and lend it to someone who needs it, right? So we're not pooling money in and then distributing it. We're doing it individual on a separate basis. It's easier for us. Not to say that it might not happen in the future, but for right now, that's just how we like to proceed because we like things to be a little more personal. And as I said, we like that low risk, low yield, mid-risk, mid-yield type area. When you're getting into more of a high risk, high yield, like I said, that's when we kind of allocate more towards a MIC. And that's stuff that we don't really want to get into. And if you actually did open up a MIC and went that way, I don't think we'd have a choice, right? We get the deal, high risk, high reward, low risk, low reward, doesn't matter. You do the deal if it makes it fit. This way, it leaves a little bit of opportunity for us to not pick and choose, but be a little bit more individualized. Hi, renewals are happening. So lender fees are charged again. It's completely different. I'm going to assume Russ or Roos, I apologize if it's wrong. I'm going to assume you're thinking we've placed the mortgage. We'll just say it's a first mortgage just for fun. We've placed that mortgage. It's ran its thing. Now it's at renewal. The client is not ready to roll over into an A. They're not ready to roll over into a B. What happens? It's different with every lender. I've had lenders that roll over no problem, sign on the dotted line and away you go. And these are private lenders. I've had lenders that straight up don't offer a renewal, right? They know that interest rates are way higher now than they were when this was originally originated. So they're actually not offering the renewal period. That's it. It's done. That person has to go find another solution. Then they take their money, they reinvest it, they collect another fee at a higher interest rate now, right? So those type of things. I've also known MICs and private lenders that are okay with it. Maybe they have to do a little bit of requalification. Maybe there's another little fee charged, right? Like a $500 renewal fee or something like that. So again, flexibility is the word, and not only with income, credit and whatnot, but with also the renewals that we're talking about right now, right? It definitely comes up. We want them in, we want them out. We want that fee again. We want that new fee. We want that new deal. We want that new client, but sometimes it just doesn't happen. And it's pretty hard to say, sorry, I'm going to take my 50 grand back now. You can't have it anymore. Go find somebody else. But it happens all the time. So it just depends on how you set it up, what MIC you're involved with, and probably the details inside of the contract that you sign and your borrower is going to sign as well. Thank you very much, Tamara. I appreciate that. And that's the end. 30 questions, 20 answers, maybe. Hopefully 18 of them were pretty accurate. But like I said, if it's not, honestly, info@greenmortgageteam.ca. This is a top-notch team. I'm fairly new in the company. Kyle brought me in about 6 months ago after, he likes to say that we dated for 2 years, where he asked me to come work and I couldn't. And then he asked me again and I couldn't. And finally he says, I bought a $1.4 billion brokerage. Now I have a spot for you. Will you come work for me? And of course, then I come work. But I tell you what, it is a top-notch team over there. They are fantastic. Their underwriting manager, his name is Jeff Shoji, and he is an absolute star. He was my underwriting manager 4 years ago when we both worked at the same firm. And everybody underneath him is equally as good and equally as experienced. And if you've been on this before, you know Kyle, and Kyle's awesome. He's a, no nonsense, extremely intelligent person. And he put that team together. So that should tell you everything that you need to know, that you're going to be in great hands if you send any email and information that you're looking to for this one. So I am not going to keep you guys on the hook for much, much longer. There's been no more questions, but I appreciate all the love that I'm getting in here, right? Thanks for pinch hitting for Kyle. Well done. Thank you very much, Bev. Thank you so much for your information. Fantastic. Thanks, Lawrence. Russ, I appreciate that. Tony, you're very welcome. And back up to Tamara again. Thank you very much. So that's all for now. I hope everyone has an amazing Tuesday. Please feel free to tell Kyle how awesome of a job I did. And other than that, make sure to check out the website for any upcoming webinars, and have a great rest of your day. Thanks, everybody.